All right. So tonight we're going to talk about taxes. I'm like a day later than usual. I usually try to put these out on Monday, but I was down in Oklahoma for a rodeo, and anyway, go figure. Airlines what they are today. I got delayed by a day and a half, but it's all right. They gave me $12, so I'm pretty happy with that. Fully compensated. So anyway, we'll still get everything done. So tonight we're going to talk about taxes. Taxes are super important. I mean, it's one thing to earn money, but trying to hold on to it is a whole different thing. And so there's a lot of whatever. It's unfortunately taxes are a bigger part of the whole personal finance situation than they should be. Things could be a lot simpler, but again, it's like anything else. I go down the conspiracy rabbit hole once again to tell you that it's stupid and difficult for a reason, because there is money to be made. And there's also just the human nature. They don't want to get audited by the IRS, so they tend to overpay. It's a completely different mindset in Europe. It's so funny. In Europe, they have a very high, they call it a VAT, which is like a kind of a sales tax on steroids, which isn't upfront. It's not listed, as a separate tax. In Germany, it's basically 20%. And if I say basically again tonight, so I'm really working on trying not to do that. But anyway, 20%. And so it's done on every time there's a transaction. So they don't have to charge as much for income taxes. Property taxes aren't that bad because they're just drilling you on the VAT. And you don't really recognize it because you go to buy something there and maybe it seems a little bit more expensive, but the tax is not overtly stated. And every time that product, changes hands, if the baker buys some flour, he gets charged 20% tax on that. If he makes it into a loaf of bread, there's another 20% charge on that. So it just cascades but they're under the implication or the understanding that most Europeans aren't going to pay taxes. They would do creative ways to avoid taxes, which is a little different. Here in the States, most people are more scared of the IRS, I believe, than they are the tax authorities in Europe. But there was never anything that was done on my house, contractor-wise, where the first question was, do you need a receipt? Which was code for, am I doing this off the books and giving you the 20% discount? Or do you need a receipt and I'm just going to add 20% on because that's what I got to forward to the government? So maybe it was smart the way they do the taxes, just have them included in so that way they don't have to worry about collecting them. But they don't obsess April comes and goes in Europe without an event. Here, you may not be at that point in your life yet, but April can be kind of a drag because taxes are generally due April 15th. Maybe you just pass them on to somebody else to get them done, but you really can't excuse yourself from not having a knowledge of your taxes because then you can't quality control their work. You're just blindly following whatever that person does. And it's good, even if you aren't going to prepare your taxes directly, you need to know how to do your taxes so you can take steps to minimize your taxes. So, integral part of the economy, paid on earned income, wealth, transfers, and then there's all sorts of things like, say DMV fees and gasoline taxes, and then they have, the sin taxes, alcohol, cigarettes, certain taxes that they just levy on top of taxes on taxes. So it all goes generally to a general fund, but they may delineate certain stuff out, like say alcohol is going to go to health programs, but that doesn't typically actually happen. It usually goes into a general fund and it's paid. And especially like for federal taxes, so much of the money is not what they call discretionary spending. If they wanted to cut back on spending, there's only a few things they can cut back on. The interest on the debt is obviously they can't change that. The entitlements they have to pay to beneficiaries, retirees, federal employees, Medicare, Medicaid, all the different federal programs, they don't have much much room in there to cut. That money's already spent. So, anyway, corporations pay taxes. Corporations have a notion of personhood where they're taxed as a corporation, and in essence, they're really double taxed because corporations are owned by people who, when their money's passed on to them, they get taxed again. So that's kind of beyond the scope of this, but corporations generally pay a fair amount in taxes. Property taxes, certainly, government services and programs, federal, state, and local level. As you know, we escape a lot of the state taxes here in Alaska. In fact, with the PFD, it could be said we actually get a refund. Local level, depends exactly where you live. In the valley, there's a few percent, and I realize other people are other places, and your taxes may vary. If you're in, say, California, for example, your total tax bite might be about 63%, which is kind of a disincentive for most people to want to work much harder if you're going to only get to keep, what would that be, 37%? So you can make taxes too high where it ends up with a smaller amount of taxes actually going to the government because the economy is not as prosperous if certain people are not going to work that hard trying to pay smaller amount of taxes. We'll talk more about that. So the IRS, Internal Revenue Service. Yep. I talked about time of transactions, so like a sales tax or a VAT tax, through payroll, and then quarterly payments. Most people do not, the IRS, if you want to overpay the IRS, if you think, oh, I'm doing a great job on my taxes because I get a refund every year, no. What you're doing is you're paying the IRS too much money, and then they're just giving you the portion that's not due to them back. In essence, you've given them a free loan for the whole year because you've overpaid your taxes. Try doing it the other way, where you owe them a lot of money. They're not happy. They're happy if you want to overpay and let them use the money. But if you try to underpay, they're going to make you set up and probably charge you some penalties, and also set you up on quarterly payments where you have to make estimates and pay taxes every 3 months if you're constantly in a situation where you're owing them money. They will allow for certain unusual situations, but can be different. The tax year, so the tax year ends December 31st. So any changes you make, anything, I'm going to sell this or do that to modify my taxes, by the time you get to April 15th and you say, well, I'm going to be paying a lot of tax, I should have sold this, should have sold that, and there's certain, maybe you've got some property or some stocks, things you could do to change things, income that's coming in that you could change when it arrives, before or after, in which tax year. You're out of luck once the end of the year has happened. So that's why it makes sense to have kind of a continual idea of what your tax burden's going to be throughout the course of the year, and not have it just be some mystery, on April 15th or whenever you decide to pay your taxes. Social Security, Medicare taxes. So different types. You're familiar with your paycheck. Seems like you're making a lot of money, and then you look at your take home and it's quite a bit less. So there's the FICA tax for Social Security, Medicare, and the other tax that just comes off your total income. But there's a breakdown. The notion, though, that there's a separate account set aside for your Social Security, they do keep track of the number of quarters you've worked, but there's not a lockbox with everybody's Social Security money being contributed to it. Social Security is really a kind of a Ponzi scheme, and that's why it's in such trouble now. It worked out quite well when the baby boomers were working, because there was a whole slug of population working and not as many people retiring. But now that the baby boomers are retiring, they're all collecting Social Security, but the workforce is less than before. So that's puts a lot of strain on the system. Social Security, yeah, 6.2 up to a certain level. This is obviously, this number's getting out of date now. It's not too much higher, so mid 120s for the amount. And if you happen to work two jobs and you haven't told either job, you can definitely contribute more to Social Security than's required. You're up to a maximum salary limit. Once you've attained that limit, they should no longer be taking a percentage. So let's say which I actually did for a while. I was making whatever in excess of well in excess of 118 with two different jobs, but neither employee, I didn't want to tell either one. They thought I was their sole gig, and I was actually working pretty hard with two full-time jobs. Anyway, because of that situation, I had to contact Social Security at the end of the year and get some of my money back. Medicare taxes. So we've got Medicare, Medicaid. Medicare is the one that you're eligible for as you get older. Medicaid is like a welfare program. And self-employed people, yeah, they still have to pay Social Security. So it gets more complex. Personal income taxes. So you've got a bunch of different forms out there. This is typically transparent to most people. You really don't care. I mean, they're giving the illusion that you're going to grab a paper copy of these forms, which you could do. I guess you could find them online or go to the post office and get them, or the IRS. But most people do things electronically, and the IRS, obviously due to the workload, they much prefer things to be done electronically. But the form that you're going to use depends on your deductions, and we'll talk more about deductions. You have two basic factors on when you're doing your income, and one is the income, and then the other one are the deductions. The deductions would be things like mortgage interest or child tax credits or things like that would come off the total amount owed. And again, April 15th is the day. So federal revenue by tax. So it's not just income tax. You can see that the numbers are super blurry here, but you can break it out visually. That income tax is only about half the taxes that they collect. Corporations, that's probably about 10-15%. Payroll taxes, so other taxes that are included. Some of those the FICA and other things. And then other taxes, some of the use taxes, excise taxes, some of the sin taxes. So a lot going on. The way our system is set up, it's a progressive system, meaning that, let's say we had a non-progressive system, meaning that somebody who makes, say, $10,000 and let's say the tax rate was 10%, well, they'd have to give $1,000, 1/10, 10%. And somebody making $100,000 would have to give $10,000, 10%. But in a progressive system, it's skewed differently. Whereas when you make more money, you have to pay a higher percent of your income in taxes. So that's where tax brackets come into line. I'll explain tax brackets, and the video I'll have really explains it quite well. You can really judge somebody, their knowledge of the tax system, by talking to them about tax brackets. If they make some claim like, oh, I don't want to earn any more money because that will push me into a different tax bracket, that person doesn't know anything about income taxes. That's the way tax brackets work is different than that. And it's a little complex, but once you understand it, you'll understand it for life, and you'll put yourself in whatever, a knowledge base of about 10% of the average Americans. Most people do not have a clue. So you can see in our tax system that these top 20% of earners are actually paying 88% of the tax overall. And that these people that I was talking about down at the bottom, these people making, say, 10 grand or something, they're not paying tax. They're actually getting money back. These are negative percentage. They're taking money out of the system rather than paying. They're taking out more money than they put in. So This is another notion. Yeah, where they say, "Oh, we're going to hire all these IRS auditors. Don't worry about it. We're only going after the wealthy people, the millionaires." Well, millionaire got defined down to 400 grand, and even that was not truthful. Most people, most people getting audited, 63% make less than 200 grand. And why is that? Because there's a lot of people in that group. And oh, by the way, rich folks can hire pretty good lawyers. It's going to be tough to get money from them. They can move, they can do all kinds of stuff, but mainly they're easier to, they have better defenses. But the sweet spot due to volume and everything else is auditing the middle class. So if you haven't been audited, it's not the end of the world, but they're not pleasant people. And if you have to hire a lawyer for it, in one case, my daughter, she's literally a college student, and she got audited, and they ended up through the course of the thing that she owed an extra $43. Now, part of the thing was I've got a tax lawyer friend, and he's a friend, but not that kind of friend. I had to spend $3,500, $500 an hour, 7 hours, only to find out that the IRS, yeah, they were right. She owed a whopping extra $43, and I'm out $3,500 in defense of that, and I get, there's nothing for the effort most of the time, and that's kind of how the IRS likes it, because most people tend to overpay their taxes, knowing that they don't want to get in an audit situation. So, again, is that ethical? No, but that's what we got. Okay, so filing status. When you go into your taxes, you may have a bit of an understanding of this, that you select a filing status. Sometimes you have some choices, sometimes not. I mean, if you're a single person, meaning unmarried, well, that is your only choice, unless you happen to have a child, a dependent, or maybe an elder who's under your sole care. There's certain qualifications that require. But if you're single but with a dependent, you can claim head of household. Now, if you're single because you're divorced, and let's say you have one child, well, both people cannot get it. One of the two is going to have to, only one is eligible. If you both try to claim the same dependent, bad juju. They'll come after you, because that Social Security number is going to be identical, that you're both claiming. So you'll get audited. All right. Then if you're married, you can file jointly. You can file the return together, or you can file separately. And this is where some of the software, or perhaps an accountant or whatever, but some of the software is actually quite useful. The thing with the software, even if you're going to do your taxes manually, or even if you're going to pay somebody to do your taxes, something like TurboTax, which is, again, not my favorite company, Intuit. I mean, because I do think that they make things complex on purpose. But anyway, you don't pay for any of that until you actually file. So you can, let's say it's November of whatever year, and the tax season's, we know the tax year closes out the end of the year, so December 31st, and you're curious, well, should I do this or should I do that? How's that going to affect my taxes that I'll file next April? Well, what you can do is you can use something like TurboTax, type in all the data you want, and calculate what changes it's going to make. So in certain cases, and it depends on the tax code, but sometimes you have somebody, one person in the married situation making a ton of money, the other one making nothing, and maybe it makes sense to file. In that case, it's just about always the case to file jointly. But maybe there's some unusual situation, and it behooves you to file separately. The laws change. Right now, there's not so much of a marriage penalty, but there was a time, probably 20, 30 years ago, where I can't remember the exception with the taxes, but there were people who would get divorced every year so they could claim that they were filing single, um, to avoid taxes. I mean, there's all sorts of weird things that can happen. So anyway, you could do your taxes jointly and then see how much you owe, or do your taxes separately, see how much you owe, and then obviously pick the one that ends up with the lesser amount. And then qualifying widower, let's say you are married, but now obviously you're not, you're a widower, so you got a lot going on that particular tax year, and maybe the next couple tax years. The IRS does kind of throw you a bone there and perhaps lessen your taxes by putting you in a more privileged category rather than just throwing you in a single. Single is going to get taxed at the highest rate because nobody's dependent upon you, so they figure they can take a little bit more from you. These are the actual forms. Very complex. Well, semi-complex, but subtract line this from line that, and it can be kind of tedious. The point with taxes is where you want to spend your time is on maximizing, your deductions and making sure you pay the least amount possible and not getting tied up in the minutia of filling out forms. It's very hard to trial run different situations when you're using, pen or pencil trying to fill out these forms over and over again. You're much better off having it done electronically, and you can just switch back and forth to see what's more advantageous. I'll go through the computer, program just on TurboTax, and again, I'm not paying these people any money. I have my taxes done, either somewhere else or actually by a CPA I've got, but I do use TurboTax to do kind of trial runs of things to see what effect different actions will have on my tax situation. Okay, so one of the numbers you're going to start with is gross income. Gross meaning everything, all included. So they're going to tax you. They're going to want to know what your salary is, interest income, dividend income, from different investments, capital gains. That means when you sell something for, more than you paid for it. And, wages and salaries. Excluding retirements, because those would be tax deductible. We'll go through those later, but there's certain tax accounts that you can have, investment accounts, that are not subject to taxes. They are subject to taxes when they're withdrawn, though. And then interest income, which is investments and things like that. Dividend income. So some stocks will pay dividends rather than the company expanding. They return a portion of those profits to the shareholders. Capital gains. And consistent with what we were talking about, so short and long-term capital gains, just as I said, 12 months is always the cutoff. So the difference is, let's say you have a short-term capital gain. It's that income from that would be taxed at your normal tax rate, which, let's just say it's 28%, as taxed as regular earned income. Whereas if it's long-term, it's taxed at roughly 15%. So generally about half. Now all this can change. I mean, if they depending on how elections go, things like that, these numbers could go way up or way down. So you got to plan ahead for that, either eventuality. Capital gains tax, yep. Yeah, so tax is ordinary income, and tax rate dependent. Typically, it's 15%. So add all those numbers together, and that's your gross. And it'd be entered online. So we're not going to spend a whole lot of time having to go through and look at the individual forms. I'll show you how it's done on the program here in a minute. So different schedules, and anyway, it kind of all makes sense at the end of the day, but it is a bit daunting. And it's just a lot of inner line here, subtract line from there. And again, it's if you're going to spend 5, 10 hours or whatever number of hours doing your taxes, rather than filling out mindless forms, your time is better spent researching the implication of your taxes and seeing what you can do to pay less. So we talked about adding all those numbers up. And then we get to AGI, adjusted gross income. So there's certain things that change, IRAs, individual retirement accounts. Those will be amounts that you will not pay taxes on. Alimony payments, interest paid on student loans, and special circumstances. Alimony is not much of a thing anymore. Child support is, especially if there's children involved. The courts definitely prefer that because that's a tax-free benefit to the spouse, to the one who gets that amount of money. So the judges will usually give them perhaps the same amount of money, but they'll call it child support rather than alimony. Standard deduction. So what's going to happen here is the government says, look, we know you're going to go through, and because you're doing this and doing that and all these income or expenses related to your job, let's say, I'm in the military and I need to get haircuts, and so that's a employee expense and it's unreimbursed, so I'm going to add up all my haircuts for the year, and I'm going to do this, and I'm going to add up all the fuel I used in searching for a job, and there's all these obscure deductions, and you're going to struggle, and you're going to get all these different deductions, and some of them are pretty meaningful, like I'll say, buying a home, the mortgage interest is deductible. Anyway, you're going to come up with some number, and let's say this collection of all these numbers, all these different totals is, say, $12,000. And if you look each year, there's what they call the standard deduction. It's just an arbitrary number. And let's say the standard deduction is $18,000. Unless your deductions added up to $18,000, just quit adding up all these different figures. You're better off taking the standard deduction. If you take your itemized deductions, if you went through and added all these things up, you only got to $12,000. The standard deduction is larger, so you're better off taking the standard deduction. So it depends. Under the Trump administration, they increased the standard deduction by quite a bit. So a lot more people, paid less in taxes. If the standard deduction comes back down, then it changes every year is what I'm trying to say. So we'll see what happens. Adjusted by the IRS each year. Yep. So this is this 2015 data. So this is old data. Right now, it's about 18,000. So, and again, depends on what your filing status is. So you see the single guy, he only gets 6,300. Not a whole lot. The married, he gets double that. They get double that. And head of household, because they've got some dependents. So yeah, rather than be the single guy, you definitely want to try and jump into the other bracket if you can. Itemized deductions. So this is what I was talking about, where you go through and you get your specific, expenses and add them up. And it can be a bit tedious, and typically need receipts and the rest of it. Now, some of these receipts are quite easy to get. I mean, the 1098-Ts, like let's say you're paying interest income or mortgage interest, you'll get a 1098 that will have that amount. So you just enter it on the form, and then you combine that with all your other little deductions, and you add them up, and then you see what's the larger number, whether it's standard deduction or the itemized deductions. This is a kind of a controversial thing. They did allow, it's called SALT, state and local taxes. They used to be able to be deducted from the amount you had to pay from your federal taxes. But this encouraged some of the states, say California, New York, that are very high tax states. The local taxes were so high that the federal government's amount of money, because this was deducted from the amount of federal taxes you owed, it was a way basically for blue states to be able to raise their taxes and not have their citizens have to really pay that much more in taxes, because the federal government was, their federal taxes were being deducted. Anyway, it just depends on the administration that's in there. So all this stuff gets quite political, but in a nutshell, the Republican administrations tend to not want to make those things deductible because the red state taxes are generally less, and blue state governors are all in favor of making those deductions because they can raise their taxes quite a bit within their state and not have their citizens penalized. So other deductions, yep, thefts, losses, job expenses. Now all these things need to be unreimbursed. Total deductions. For example, you can deduct medical expenses, but there's a couple caveats. Number one, they need to be unreimbursed. So you can't claim something as an expense if insurance is reimbursing you for it. Also, you need to be fairly sick, because typically there's you can't take that deduction unless the medical expenses exceed 10% of your income. So let's say you're making $100,000, you have to have $10,000 of unreimbursed medical expenses before you can start deducting them. Now again, these numbers will change slightly, but yeah, you don't want to be a person who's got that much in the way of unreimbursed medical expenses. You're quite ill and you don't have very good insurance. So the itemized deduction, so there's all sorts of different things on here, and it's quite easy to do if you're an experienced CPA, or if you are using one of the little programs that queries you about, hey, did you do this? Did you do that? And it leads you down a simple checklist to make sure you don't leave any deductions behind. And TurboTax. We'll go there in just a second. Exemptions. Typically, exemptions, they're an amount that can be deducted for each person who is supported. So, again, you can claim exemptions for yourself and then people who are dependent upon you. And this just determines what your taxable amount is going to be. When you come up with all these numbers, it'll say subtract whatever from line this from line that, and your adjusted gross income minus your deductions, and then you go to a table and it'll tell you, okay, based upon your income, this is how much you got to pay. And anyway, that table will be based upon the number of exemptions you have. Affects your withholding as well. So taxable income is just what I said, the AGI minus deductions and exemptions, and then comes through. So progressive tax system, this is what I talked about before, where a positive relationship exists between an individual's income level and tax rate, meaning that if you're making $100,000, you're going to be taxed at a higher rate. So not only is the dollar figure to be considerably higher, which would be the case in just a straight percentage, but it's going to be even higher because the percentage taken is going to be higher as well. So these are the tax rates. So this was for 2024. So 10% tax rate. So you're only making, this is for a single person, 11,600. So yeah, they're not going to try and take 37%. 3,700. No. To get in the top tax bracket, you're going to be making over 600 grand as a single person, 730 as a married person, and then 609 again, which will look similar to the single filer numbers. But the way tax brackets work is that 37% is only taken on that last portion. So again, they can do a better job in the video, but let's say you're making 100 grand, right? What's going to happen is on that first 11,600, that rate is going to be charged at 10%. So you're going to be paying 10% on that first tranche, that first segment of your income. The next segment of income from 11,600 up to 47,150 is going to be charged at 12%. Now they're saying, okay, you're making pretty much 50 grand, 50 to 100 grand. We're going to take 22%. We're not taking 22% of everything. We're just taking 22% of everything between this 47,150 up to 100 grand. So let's say somebody's making 100,525 and they're offered a raise. They're going to get paid 110,000. Like, oh, I don't want to take that extra money because that's going to push me into the next tax bracket. I'm going to be up in the 24% tax bracket. That person does not know really what they're talking about. What that means is that extra 10 grand, whatever, it's a little less, that part that's above 100,525 going up to your 110,000, it's going to be charged at a rate of 24%, but not all of your income. So you're still making much better money. It's just incrementally that last little segment of income that you're making is going to be taxed at a 24% rate, but not all of your income, just that part that's above 100,000, 525 up to that 110 that we said you were going to make. So that's how brackets work. Now, if you're somebody who's only making 10 grand, your tax rate is 10%. And then you're going to fill out a few more details and you're probably going to find out, oh gosh, I'm actually getting money back, because it ends up being kind of a welfare program for people making less. They take out more than they put in per the system. Capital gains rates. So when I said 15%, that's for most of us, right? And again, long-term capital gains rate. So if they're short-term, they're going to be charged in your normal rate. But when I say capital gains are charged at 15%, the reason I said that and just kind of generalized is because most people are making more than 36.9 and they're making less than 4,000, whatever. So the only way you're going to pay that 20% capital gains rate is by making more than 400 grand. And if you're not making, you're not even making 10 grand here, they're like, yeah, life's tough. Or actually, you're making less than 36.9. Life is really tough down here. Here it's 36.9 is not a lot of money. So they're like, yeah, if you can make any capital gains, God bless you. Keep them all. We're not charging you. Now, if you're making above 36.9, we want 15%. Fair enough. This is based on your income. They don't care. I mean, if you make well, whatever. So, yeah, investments are taxed differently than income, but that's what they're talking. Determine your tax liability. So, yeah, go on the tax schedule. You're going to turn to whatever page. You're going to look in the column, or you're just going to use the software, and it's going to tell you how to do it. Child tax credit. These numbers can change. You know, the U.S. obviously, actually worldwide, populations are dropping, so you can probably see these things going up under whatever administration. College expenses up to a certain limit. You know, I sent one of my daughters to Auburn, and I thought, oh man, this is going to be good. I'll get these college expenses will be deductible. Nope, there's an income limit, and I just barely exceeded it. It's an all or nothing thing. That was something where if I would have been making about 5,000 less, I would have actually saved quite a bit in taxes. But anyway, savings accounts. We'll talk more about that in investments, but generally the government, the way the tax system is written, is to incentivize and disincentivize certain behaviors. So some of the things are quite clear. Taxes on alcohol and cigarettes, yeah, they don't want you doing that, so they're going to tax you. They do prefer that people own homes, and also real estate's got a good lobby. So home ownership is taxed favorably. You know, we're all like rats trying to get the free government cheese, and so we're trying to get through the maze. And so if you, whatever, that's why there are tax deductions. Some people say, oh, that's a tax loophole. There are no mistakes in the tax code. Everything is put in there with some intention. They're not always great intentions, but there are specific parties that put certain things in there. So if you hear somebody say, oh, well, there's a tax loophole, yeah, one man's loophole is another man's, intentional benefit. Somebody had that placed in there because they wanted to incentivize that situation. Now, again, not all of the situations are good, but some are actually quite good. Child adoption tax credit. Adopting children rather than having orphanages and the rest of that. That's a good thing. So the government will incentivize that. I guess some of the IVF type things are going to be incentivized as well. They need more children, and the financial burdens associated with having children can be quite immense. So, giddy up. They want people to go to school. So if you want to save for college through a 529 plan, what they'll do with that is you can put money, say, in like a stock account for your child, and you say this is going to be a 529 account. It's only going to be used for educational purposes, and you can withdraw that money tax-free as long as it's used for your children's expenses. So let's say you're going to do the right thing. You're going to put away a certain amount of investments so that your child has $100,000 for college when they get to that age. And if you put it in a 529 account, guess what? They'll get the whole 100,000. If you have it in a regular account and you give your child this 100,000, it's going to be subject to capital gains, so they're going to get somewhat less, 85,000. So anyway, it makes a huge difference. Now, if you don't use it, let's say little Johnny doesn't turn out to be the child you hope for, and whatever, and you want to pull that money out and use it for something else, then you can do that. There'll just be penalties, plus you'll have to pay the taxes on it. So still not a bad way to go in case, you always hope for the best. You're not trying to raise a felon. But if you end up with one, well, you're not lost the money, you just lost a portion of it. Earned income tax credits. So that's what I'm talking about, people getting more money out of the system than they put into it. And then child care adoption, certainly. Again, back to TurboTax. Okay, so let's look at TurboTax real quick. This is going to be homework problems, just a couple items. I had logged on to TurboTax before. Sometimes they're quite unfriendly. Yeah, here they go again. So trying to get back on here. This is just a fake account. This is not my actual, actual data. You don't have to give these people all your data. In fact, it's probably, if you're not going to file with them and you want to just establish a bogus account, perfectly within your rights. You don't pay anything until you actually file. So what I want to show you on these things are just a couple things. There's a notion of a tax when somebody says something is tax deductible versus a tax credit. Those are two different things. Let's say you give $1,000 to charity, and they say, "Oh, well, that's tax deductible. It's a tax deductible donation because you gave it to a qualified charity, not a political campaign. Those are not tax deductible. But let's say you gave it to a legit charity, and it is tax deductible, meaning that let's say you're making $100,000 a year, your income now when you report it to the IRS, once that deduction is processed, you will be paying the taxes of somebody who made only $99,000 a year because you had $1,000 tax deduction. Now, how much of a benefit does that give you? Well, it depends on your tax bracket. And let's say your tax bracket was 28%. Well, so by giving $1,000 to this charity, you pay $280 less in taxes. So of every $1,000 you make, in this case where you're making 100 grand, you're in 28% tax bracket, because of taxes, you only get to keep $720 of that. And you pay the other $280 in taxes because you're in the 28% tax bracket. So anyway, in essence, you give these people $1,000 and your wealth is declined only by $720. So you did get a bit of a benefit. Now let's say you're doing something like, the adoption thing, and there's a tax credit, or there's a child tax credit. Credits are good. Credits are great. The way credits work is they're not a deduction. A credit is, let's say you run through the numbers and you owe $18,000 in taxes. Now, granted, you're not going to pay all 18 grand on April 15th. No, you've had money deducted out of your paycheck every month. And so let's say you've already paid $15,000 by all these payroll deductions over the course of the year. So your tax bill at the end of the year comes up to be $3,000 you owe the IRS. Well, if you have a $1,000 tax credit, that comes right off your taxes. So you owed $3,000 in additional taxes beyond what was deducted from your paychecks. Now you only owe $2,000 because you had a $1,000 tax credit. So all this stuff kind of comes into play when, let's say, you're thinking about buying a home and you're trying to compare it to renting a home, and you're trying to figure out what's the all-in cost and how much money am I going to save. I know my mortgage interest is deductible. I know there's some other things involved. How's that work? Or I'm thinking about giving some money to charity. How's that work? What's going to be the net effect on my taxes? Well, you can do it fairly quickly. So let me just show you. I went through here and I said, I just put in notional numbers. I made exactly 100 grand last year, right? So that's the income. And then, and we can go through and look at the details. I didn't put a whole lot of details. I just put enough to make the program run. So you can step around in the program. I just put in called myself Jay. I put a W-2, 100,000. I put that 15,000 was already withheld. Okay, so on my W-2, there's going to be all the different columns on there that you're going to look at. And, truth is on TurboTax or these other ones, you can actually load these things electronically where you don't have to actually type in the numbers. You type in where you work, your social security number, a few other details, employer ID, and boom, it downloads your W-2 and calculates all these numbers. But here I did it manually. So this is not outrageous, making 100 grand and having 15,000 in deductions already withheld. So what you want to do with your withholdings is kind of put you in the ballpark so that you're fairly neutral. When April shows up, you there may be some fine tuning, but most of your money has already been paid. If if I didn't have enough withholdings done, then the IRS would be kind of upset and they'd start assessing me penalties. If I had 30 grand withheld, well, then I was just a buffoon and I gave the government a free loan until April. So, anyway, let's look at some of the other details. So you can type in all your details. And the other thing about this is it saves all your data from year to year. So it's quite good. They're going to walk you through each menu, but I'm just sort of jumping around. Here I'm going to go into deductions and credits because I want to see what's going to happen. On this one, let's see, I talked about mortgage interest deduction. And it says I paid $15,000. Again, there's a thing called the 1098, and I put WF like as in Wells Fargo, and I still owe $280. I'll also make a difference when we start calculating the final numbers. The 1098s are the forms that are used. Typically, the numbers of amount of tax owed will show up here in the column over here to the left. So let me go back. I may have to pause the recording for a second to figure out why the numbers are not showing. Add more income. Nope, I'm done with that. Let me pause this thing for just a potato. Well, I'm a little frustrated. I took a break here and I looked at some items, and they used to show a running total of how much taxes were owed, and they say, oh, they deleted it because it was basically upsetting people because they'd make changes within their taxes and they couldn't figure it out. So perhaps they'll add it back in, but that was a pretty good feature because I was going to show you a couple things in terms of deductions. Anyway, we'll just basically step through these deductions really quick. But it is kind of helpful, and you have seen the forms and trying to enter in and remember what's deductible, what's not deductible. The programs do make it a bit easier. And I was going to show you kind of the difference between the tax deductibility and, tax credits like we had talked about. But obviously I just had to kind of explain that to you, that deductions are not nearly what tax credits are. Tax credits are a one for one, and deductions are based upon your which bracket you're in. But the program is pretty useful in helping you figure out which deductions are available. In fact, let's look at medical expenses. We'll go through here, and so in this case, I was saying $10,000. Now they're saying it's down to $7,500. But did you spend more than $7,500 on medical expenses? And then it also, lets you know, what you can deduct, some of the Obamacare, healthcare.gov type stuff, medical savings accounts, health savings accounts. So there's a lot of data that's packed in here. Again, you can't just do the taxes on your own, but it's so complex now that it makes it a little bit more difficult. And so let's look in here, what expenses can you deduct, and it'll talk about things, that have to be basically non-reimbursed. So hospital fees, prescription meds, miles driven. So things could add up, but again, $7,500 is a pretty high threshold. Taxes are always done in arrears, so it's asking me questions about 2023 since we're not actually paying taxes for 2024 yet, and that's why some of the stuff is a bit jacked up because we're kind of in between tax years. Anyway, but all in all, I think their old program was a little bit better, to tell you the truth. Seems like they make changes every year, but maybe not improvements. And then you go through and you can do a review and make sure your numbers add up, and it'll tell you if your forms are checked out. So again, I'm not spending any money here. I'm running through and trying to get an idea of what effect it's going to have on my taxes, and then it's going to come up with the final number, and it's going to has access to all the tables, and we'll just keep hitting continue since I've already entered the data, and it's telling me I'm going to get a refund, and then it's going to go through sort of an explanation of why the refund is due. So in this case, it goes through some of the details saying that my income was $100,000. I filed singly. The itemized deductions claimed I was up to $24,000, and that's because I had a huge amount of mortgage interest I was paying. So $15,000 interest, and then the state and local taxes paid were $9,000. What my taxable income was, that's based upon the reduced amount. So you can see it comes down a bit after the deductions. So the deductions are subtracted from that $100,000, leaves me with the taxable income of $75,900. Total tax I was going to owe would be $12,000. I had $15,000 withheld, and so they're saying, oh, basically you withheld too much, and so you're going to get the $29.89 back. And so when you get a refund, it's because there's a difference in the numbers, which there just about always is. And as long as it's close, no harm, no foul. But if you're not withholding enough, and the IRS they feel like, hey, you should have paid that money throughout the course of the year, and we don't want you to do that again, so we're going to hit you with some penalties. So, and then you can go through, and you could spend quite a bit of time, on this process to sort it out. And you do get a printed report, and you typically can file it all online, so it does make things a bit easier. If you lived in the state where you do have taxes, this would be a factor. They can file your state income taxes too. But I've already put in my data saying I live in Alaska, so skip it. Skip state taxes, don't have to do it. And check my return. So again, QCing some numbers for you, and you get access to the basic forms again if you want, and go through, and then again some suggestions on how to reduce how much tax you may have to pay next year. And this will go through, and some people may find this pretty helpful, others may not. But taxes themselves can be kind of daunting, but the amount that you actually pay, there is a bit of strategy to it, by knowing what's tax deductible, what the impacts of different actions you take. If you're renting a home or renting an apartment or whatever, that landlord is getting the tax breaks. You aren't. You're just paying whatever amount of rent, and those benefits that go to the homeowner are passed on to him or her. So that's about it. Unfortunately, the way they've modified this program, it makes this portion of the lecture a little less dramatic. But we'll talk about the tax implications of all elements of personal finance more as we go throughout the course. I do have the new book put in, so I will be posting the rest of the questions, and I'll also have your video questions ready to go as well. So, till next week.